Good evening to everyone. I'm hoping you're all fine and all set to take a second leg of this revision course. We are in advanced taxation revision course, and we already have had one leg of it on a whole day of Saturday. And today we are in a continuation of that revision into the second leg. I started off with a bit of a delay, which I already announced it even on Saturday because it's a working day. So most of the students, by the time they come home, they get late because of traffic, because of some other work-related commitments. So it had it in my mind to start the course with a 30 minutes of delay. So we are starting it off with that 30 minutes of delay. The people might keep coming in. We will be dragging this course by I would say 30 minutes, a little extra, because we are starting this course with a 30 minutes of delay, so that to compensate for the loss of that time, we will extend this course also by 30 minutes towards the end. So you people are already been aware of what's the agenda of this revision course and how we have been taking this revision, as you have been the part of the whole session on Saturday. We have been working the questions from both the section A and from the section B type, covering the range of topics, getting the art of how one should have to answer, the workings, the explanation part, the marks allocation, the time management, lots of things we already have talked about. And the same will continue in a session of today, which is going to be a usual session for all of us, as we tend to take even a course that lasts for 4 hours. So the course of today is going to be like 3.5 hours. So sit there and watch what has been planned for you. We have done lot much time spending the time on individuals on Saturday, and that will continue today. Towards the ending part of the course, we will shift ourselves towards the corporation tax, the corporates. If we look into a table of contents in the file, the question name Olma Hogan, the question name Yacon Limited and Dicon, Rosa, Pedro, and Emmy and Bax. These were the 5 questions we have spent the whole day of Saturday on. Lot many things we have talked about other than this, like in the first 1.5 hours of the revision course, lot many useful stuff I was sharing it out to all of you. And then we started off in the revision and did spend like the rest of those 7 hours on completing these 5 questions, out of which 4 of them were the section B type. And the one question that we have done was on the section A type. It takes a time when you practice an exam style question. And if I'm not just solving these questions out, rather also explaining it properly, talking about the planning of it, which part to solve first and second, the time management, the spreadsheet part and the word processor, it takes a time. So if I look into the side of individuals, we are left with one more question on section A type named ZT, and 2 questions of the section B type. What we can do, we can start the course of today by taking yet another section A type question, because section where we are focusing a lot on section B type questions, we also have to pay a lot focus towards section A type. So why don't we start the leg of the revision course? Sorry, from the section A type question itself. And then we can work one more question on section B type before we can take ourselves down towards the companies afterwards. Surely, we will not go to work 2 questions of the individuals. we will take one question of section A type, and either of the two, sorry, either of the two, Liber and Jonaito and Buraco. These two are section B type. So we can do either of the two with this one also. And then we will go into the corporates. Let's get into the question named ZT. You know that the section A type is a difficult question and it takes time when you have to formally solve it. We did spend like 1.5 hours to 2 hours in between. I remember it was 1 hour and some 50 odd minutes like we've spent on Olma and Hogan. Same sort of a time we can expect to spend on the question named ZT. So with this, let's land ourselves onto a page 38. That is the question. Let me bring the whiteboard explanation of that in front. And the solution, we always keep an eye on that after I gave you the whole sketch of it first. The best part of this revision was that when I was reading it out, the question and all, I was, before revealing the solution of it, I used to draw a sketch or a theme of that beforehand so that when you come back to read it, you find it easy to read it through from the standard solution. I will do the same for the ZT also. Let me make this whole file ready. And now we can start working. Three exhibits. You people now have become quite much familiar to the way the section A type question is tested. There are always three exhibits. Third exhibit is the exhibit of work to be carried out. Remember? Like we have done the Olma and Hogan, third exhibit is always an exhibit of requirements. While the two of those exhibits, the first one is basic, focusing on ZT. The second one is still focusing on ZT, but it probably will have something else to look in. And the first part of the question tries to tell us that what you are aiming to answer from. Like they are testing us on the value added tax implications, inheritance tax implications, investments into EIS and VCT shares, and net proceeds after income and capital gains tax from the disposal of his unincorporated business under the two of those alternative methods. So your manager received a letter from ZT. Who is ZT? So you have not received an email, your manager. You work in a tax department, either as a senior, junior, assistant, no matter whatever the rank that you carry. But it's your manager who has received an email from ZT. ZT must have been a client of our tax firm. ZT owns and runs an unincorporated business which was given to him by his father. So Ravi is a father who has inherited the business of his own to ZT, probably a daughter. I hope she is a lady. The name ZT looks to me a name of a lady, not a guy. In addition to some ethical considerations which have been raised by your manager, ZT requires to have an advice onto these four things. Yeah, the ZT is the client of ours. She runs the business that was inherited to her by her father when he died. No, I haven't seen anywhere as the death of Ravi. I'm just assuming. But the father might have been alive right now and may have gifted the business to her while he's still alive. But overall, gift of the business by Ravi to ZT, and now today the ZT owns this business and runs, requires to have an advice on to these four of those things. Exhibit number 1. Reading the section A type question is a tough thing, and you have to be a lot patient on it. You have to highlight it, underline it, make some points out of it in a scratch pad for you to later remember. Extract from the letter from ZT. I have decided that due to my father's serious illness, now this is ZT writing. I have decided that this is ZT has decided due to my father's illness, I want to able to look after him on a full-time basis. Accordingly, I am going to sell my business. Fine. And using the proceeds of that to buy a house nearer to where he lives and some shares. So she lives somewhere else and she wants to look after her father. In that case, she wants to sell her entire business, and by the proceeds that she will go to get, she will go to buy a house nearer to his place, and the rest of the money she might be investing it in some shares. So are you understanding the whole story? Very important. You just do not look for the figures into it. You also have to look into the whole story. The story is unfolding. My father started the business back in 2010 when he purchased the building referred to in the business assets below. He gave the business consisting of goodwill, building, and equipment to me. And that is the day the gift was made. So the gift was made to her while he was alive. The day of the gift is written, which definitely is going to be a potentially exempt transfer as far as the capital gains inheritance tax is concerned. And as far as the capital gains tax is concerned, this simply is a gift of the business assets. We submitted a joint claim for the holdover relief. So as far as the capital gains is concerned, they have claimed a gift relief such that no capital gains tax was paid at the time the gift was being transferred by her father to ZT. I have no sources of income other than this. Okay. So do you understand? She today owns a business that she wants to sell so that the proceeds that she will collect, she is going to use that proceeds to buy a house nearer to her father's place so that she can go and look after him. Now they tell us the history. This business was established by him back in 2010 and gifted to her on 1st of July 2020-21. And they have been able to claim a gift hold over relief. So the gain on the transfer of business, whatever was realized, was totally relieved by claiming the gift relief. I have identified two possible methods of disposal. So she's considering two possible ways of disposing her business. The first is a preferred approach of her. Close down the business. Close down the business means she will cease. The business will close down, not will transfer to someone for someone to run. Close down means it's the end of the business activities, disruption. I would do this by selling the building and equipment on 31st of March 2006, at which point I would seize the trade. Yeah, so in the very first possibility, she wants to close it down and sell the two of the assets that the business has, equipment and the building, and then she will sit home afterwards. Second, the father would like to see the business to carry on. So this is the wish of a father, that the father wants this business to carry on. So she'll go to transfer it to someone, and that someone will run the business on the behalf. For this to occur, I would continue to trade until 31st of, so she by herself will continue to trade by one more extra year, and then sell the business to my sister, who would then continue to operate. So you see that sister. So another daughter, you can say. Name of that lady is not mentioned, but that is a sister of Ziti and the second daughter of the same father. I will charge my sister the market value for all the asset except the building, which I will sell it for her for 300,000. So market values, probably they will give her, they will provide, yeah, in down below, they've provided us with all of those market values, except one asset she will sell for 300. That one is building. My sister is not willing to make a gift holdover relief. So then afterwards, Ziti and her sister, they will not go to holdover the gift relief. I attach an appendix setting out the information you requested in relation to business. In order to keep the steady income stream, I have plans to purchase a rental property, which I would let as from this date. The annual taxable rental income is gonna be 52,000 because she is no longer in a business. And she wants to, obviously, she have to make her living. So she rather invest some of the cash in property so that she can make the rental income. Rental is a fixed income. She continue to get that income out for all of those years to come. In the first year, she's going to get 52,000, which is going to be tax year 26, 27. And this disposal is in tax year 25, 26. This one is gonna be in tax year 26 and 7. Yeah. Sadly, I have been told that my father is unlikely to live for more than 3 years. Okay. He is nearer to expire. Please let me know whether his death could result in an inheritance tax liability for me in respect of the gift of business. Okay, this point is asked from the perspective of inheritance tax because you know that when the donor makes the transfer, becomes taxable upon the death if the donor dies within the 7 years of making the transfer at the rate of 40%, then we come to reduce it by the effect of taper relief at the rate of 20, 40, 60, or 80. Depends it upon the whole gap in between the death and the gift. So this will take us back to inheritance tax talk. My father's only lifetime gift, apart from this business given to me, was a quoted shares to discretionary trust. So we also can see a CLT being made in the past by a father. The shares, they had a market value of 190,000 at the time of the give and did not qualify for business property relief. So this one is PET. This one is PET. And they are suggesting that the father has also made the transfer in the life before then this, the value of which one is given. And that is definitely going to be a CLT because that's a transfer to a trust. Appendix 2. So how easily I've been able to keep the whole of the data of the exhibit number 1 in my mind. Exhibit 2 needs to be read because it's attached with this one. Now they are providing us with all the figures of goodwill, building and equipment, original cost, market value on the date it was being gifted by a father to Ziti, expected market value if she goes with the very first possibility, market value if she goes with the second possibility, because the first possibility will be exercised on 31st of March 26. The second possibility will be exercised a year after on 31st of March. So they have provided us with the market value of all the relevant times. We'll definitely go to use the relevant ones dealing with each possibility. This is the day of the transfer of a business by a father to Ziti, 1st of July 2021. Costs are also given. Final position of financial position of a business. From 1st of April 2025, can we assume that the business generates the trading profit of 5,000 each month? The trading profit will increase to 6,000 as from the next year. Okay. So 5,000 for the first year and 6,000 for the second year. I've always prepared the accounts using the accrual basis. The only tax adjustment that is required to be made into this figure is in respect of capital allowance. So these profits are going to be adjusted. The only one adjustment we will have to pass it in is the adjustment of capital allowance. The tax written down value of the main pool on the 31st of March is nil. Okay. I purchased a business equipment for 6,000 on 1st of May 2005. There have not been any disposals of equipment since that date. I'm happy to make any elections where, okay, so purchasing an equipment in a year of closure results in claiming the balancing allowances, balancing charge. because you cannot claim any capital allowance in the year of cessation, which in fact is this gonna be. So purchasing an equipment might not gonna attract AIA. It's all the knowledge of the tax. If you have it in mind, you can come to bring that in and apply. Tax efficient investments. After selling the business, I plan to use some of those proceeds to buy shares. Yeah, as she was also planning to do that. Remember, we have read this somewhere. Yeah, to buy a house and some shares. So she is wanting to invest into either EIS or in VCTs. After selling the business, I plan to plan to make some income. I hope I will save some income tax and small amount of income. I may consider investing into EIS shares, but I'm aware of the high level of risk is involved. However, I understand that the VCTs have the lower, yeah, if you can recall the knowledge of these schemes, EIS, VCTs, Enterprise Management Incentive Scheme. EIS is more riskier because you commit your investment to that one company. And if that one company flops, you lose your entire investment in. Although, if this company becomes a profit making one, you make better returns. High risk, high return. The simple mantra of your finance. So, because you commit the whole of the investment to that one company, you take a lot of risk. In the case of the company does not make the profit, you lose your investment in. Or if the company makes the profit, it gives you back good returns. While VCT has a lower level of risk. Why? Because VCT is a portfolio of many EIS companies. You give your money to VCTs, and then VCTs on your behalf invest into various EIS companies. So your investment is actually spread out over many of those EIS investments. And this way, the risk is minimized. So I mean, again, this knowledge, because I have it, so it's easy for me to talk about. If you do not have the knowledge of these two schemes sitting into those right now, first of all, you have to accept that you are not well prepared. Just about a week away from exam, still not having been aware of the EIS and VCTs, the characteristics of each of the plan, the properties, the tax incentive. And then after 7 days, when you will be in your exam, or 6 days, 8 days, you will come across to these two schemes. You will not be able to talk about it because you just do not know. This thing has got nothing to do with the entire case that we have read. This is going to be probably another part of this question. Please let me have the comparison of the income tax implications of these two forms of investment on the assumption that I will invest this much in tax year 27-8. I plan to keep the shares for at least 5 years. Payment from HMRC. I have received 5,000 into my bank account from HMRC. I do not know what it relates to, but it is this error. If this their error, so I'm going to keep the money. If it is their error, so I'm going to keep that money. Look, how funny is that? They receive 5,000. She received 5,000 from HMRC. He becomes so happy. I do not know what this relates to. She has no clue what this 5,000 is about. She just had received it. Now, this she says that, but if it is their error, she is assuming or saying that, okay, if this is the error of HMRC, fine, I will keep the money because the error, I haven't done error. So they probably will go to ask us about the ethical consideration that now what action do we have to take it into disregards as ZT, and as a tax advisor of ZT, what should we have to do with that? Should we have to inform this to authority directly? Should we have to inform this to client of ours first and let the client to tell them? And if they have to repay this amount back to authority, what do they have to do it? But we also have seen a question of this kind in also in one question before. For 5 marks somewhere, they're going to asking it about that, what to do with this 5,000. One thing is for sure, obviously, that's not their money. They won't be able to keep it. They have to return it back to authority. So in case they do not, they might have to face the criminal proceedings, because this might come under the banner of tax evasion, might gonna fall against the money laundering regulations also. Additional company background, Ravi and both are the resident in UK. All the equipment is movable and no item has a cost or a market value more than to 6,000, means chattels, movable and more tangible items are called as chattels. And if the chattels are not being sold and purchased for more than 6,000, they're exempt. So why the word 6,000 has used? Because they want us to remember that one rule that we apply to chattels, that when they are being bought and sold for more than or less equal to less than to 6,000 pound, we could just go to make them exempt. The business is registered for VAT. Fine, no election has been made in respect of building in relation to VAT. So I took like 20 minutes, not 20 minutes, I would say, 10 minutes. Maybe you can add 1 or 2 minutes to 10 to 12 minutes. I took it like to read it, because reading is important. It was not the waste of time. It has let me know that what this case has to offer. I mean, I have all the case above in my mind now. In the last part, they want to invest into two plans, two schemes. We have to let them know about the tax savings in regards to two of those schemes. Then they tell us about this error of 5,000, which probably has been done by the HMRC. So what action do we have to take it, being the advisor to Citi? These were the two separate issues. The main issue is the sale of business by using those two possibilities, by closing it down just or by making a transfer of it to her sister. See, I have all the story in my mind. Market values, the relevant they have given to us. Pet, before than that, Ravi has made. They also have told us about the CLT being made in the past, and I labeled that for all of you. Fine. So one by one, we will look into the requirement and can start working. So they want us to focus on both the exhibits, even for the first part, which has further been divided into many parts. And such a massive part, 17 marks. Means this is that one question that's going to give you the most of the marks out of it. And a lot of work is required. Calculations to enable the ZT to compare the financial implications of two possible methods of disposal. You will need to calculate what? First of all, the taxable trading profits and income tax and capital gains tax payable. So you need to, in the very first, calculate the trading profits. Then you work an income tax on. Then you work the capital gains tax on. You should include the explanations of availability of CGT reliefs. So if any of those reliefs are available, such as business asset disposal relief, gift holdover relief, you must have to talk about. Or from inheritance tax side, BPR, business property relief. Summary of post-tax cash position and any necessary assumptions that you probably gonna make. Post-tax position is going to be the end product, because you have to first of all find the taxes, which later you will be able to offset it against the inflows, whatever is going to come to her way from the sale of business. When the proceeds of this asset, means when the business will be sold, she will be selling it, and whatever the proceeds she will go to collect, we will have to offset the taxes being worked in the first part to get this one out. So this is the end product. Explanations of whether or not the VAT would need to be charged on. So this requirement is totally a different story. And see for how many marks the topic of VAT has been tested in. 5 marks. That's the importance of value added tax. Not gonna be more than. They exactly want us to answer the VAT implications of exactly achieving the sale in both ways. First way was to close down the business. Second way was to transfer it to a sister. So we need to come and answer the VAT implications of two possible events. And if again we have a knowledge of that, we will be able to easily answer. But in the very first place, we have to peacefully concentrate on the figure work. This is all figure work. Computing the profits, computing the income tax, computing the capital gain is a figure work. Reliefs to apply, not to apply, we will see on the way. And this is going to be the end product of that in the end, on which the 17 marks will handsomely be achieved if you're technically a strong candidate. The 17 marks are so easy to score if technically you have a command over to a figure work. Not 17, I would say 14 to 50 marks you certainly get if you have a command over to the figure work. So I'm into part A1, going to produce the solution. Even the same thing we have experienced it. You do the question of section A type or you do the question of section B type. Section A type is just the double of section B type. Otherwise, it does not have. And by the way, do they want us to prepare a memorandum? They respond to the instructions in an email from your manager. So our response obviously will be in the form of memorandum because memorandum is an internal document. You're not gonna send this to someone outside. Your manager will then later on. So memo, and memo has a specific start and that will give you professional skills marks. The other day we have seen that you actually come to write the subject. You then come to write the client for which you are going to respond this, and then you go to write who you really are, tech senior, and then the date which is being given to us. Whatever the date they want us to assume is going to be the date of the memorandum. So if I just go to reveal the solution of that, that's exactly what you're gonna see. Tech senior, who you are, the date and the subject. And then after that, it's a body. Told you all the time that you must have to make the headings and the solution will go in a spreadsheet if the pro forma of computations are there, and then the writing part will come onto word processor, which should take the form of paragraphs, or you can also use the bullet points where necessary. So that is the heading. Sale of business is a main heading within which they want us to find the post tax proceeds. Tax and income tax position will come into play on the first. Then will come the capital gains tax implication. After so much of time, we will then go into CGT position because that's exactly they have demanded us to work. In the very first page, they want us to work the income tax implications, and then they want us to work the capital gains tax. The broader heading is sale of business. You can copy and paste the same from the part A. That is a broader heading of this, within which the subheading is post-tax sale proceeds, within which the income tax position will come first and CGT position will come after. Once you're done making the nice start of it, then your knowledge will give you a push to try and get the most of the marks out of it. Just hold on. So in the sale of business, the heading is sale of the business. In the first possibility, when is the day the sale is taking place? Let's go to mark that date. My preferred approach would be to sell. To close the business, I would do so by selling the building and equipment on 31st of March 2006, at which point I would seize the trade. Thirty-first of March 2020, 26. The first thing is that we have to work the profit, trading 5,000 per each month. I was given 5,000 from 1st of March 2025, April 2025 to 31st of March 6. They will have 5,000 a month. So I will multiply 5,000 by 12 times to get me a figure of total profit, which is 60,000. Then I will go to make the effect of capital allowance, because they say that the profits are all adjusted, except the one thing that we have not done yet, that effect is the effect of capital allowance. And like we know that in the year of cessation, the capital allowances cannot be claimed. The opening tax WDV is 0. They are buying an equipment, the value of which one is 6,000. So on which the AIA will not be claimed, this value will directly be transferred to pool. So if I go to construct the pool on the same page, the opening balance of this pool is nothing. I mean, on 1st of May 2025, the opening balance of that is nothing. They have purchased an equipment which, without writing it into a column of AIA, I will go to throw it directly into pool. That's what we do in the period of cessation. No allowances whatsoever are claimed. We go to record the purchase of the equipment directly into pool. No written down allowances can even be claimed. And then we go to compare it with the proceeds of the disposal to see if we end up finding the figure of the balancing allowance or a balancing charge. So when they will shut down the business or when they will seize the business, the goodwill will not arise. The goodwill arises when there is a transfer. The business will continue. In the second possibility, the goodwill will arise, and that was also been mentioned here. I would do so by selling the building and equipment. So you won't see even a word of goodwill has been used. Because when the business is shut down, the goodwill does not play a part in. The goodwill rather plays a part in when the business has been purchased by one person from another one. And in that whole event, the goodwill arises. Purchase goodwill, which is going to be the case in the second possibility. So the two things we have to look at. The first one was the equipment. The second one was the building. So what has been the market value they've given to us on the date the business will close down? Focus on to the date and building. Leave the case of the building out. Focus on equipment. 10,000 has been the market value of the. So I will be deducting it as a proceeds. This is the figure of the balancing charge that we have ended up getting. This has been the value of the equipment that's being sold up for 10,000, 4,000, more than 2. So that must have been the figure of the gain, and that gain is called as the balancing charge. And this is the amount that I have to come in, add it back into a profit. I can write it, the figure of the balancing charge. This way, the profits are funnelized 64,000. And once the profits are funnelized, we will then go to work and income tax on it. So, what is going to be an income tax liability? It's very simple to calculate, provided the person does not have any other further income other than this. We'll just have to find the taxable amount of trading profits. The trading profits are given as 64,000 with the deduction of personal allowance to make these profits taxable 12570. And once this profit has turned out to be a taxable one, we will tax it. 64,000 minus 12570, it's 51430. 51430. 51430. Up to 37700 mark, the rate of tax is 20%. Excess will be taxed at 40%. If the person does not have any income, which I don't feel that person has any income, because that income will come in the next tax year, 51430. The figure is going to be 13730, 13730, 13730, 549, 37700, 7540. 1303. So this is the income tax liability that we've been able to work, provided I can once again come to check if this year does not have any further income except this. Yeah, because she will have a rental income, but that's going to be in the next year. When I was reading the facts, I've realized the tax income, the property income will come in next tax year, not in this. So in this tax year, she only will have this much of profit, which we have taxed. Now I can take the same moment or to work the income tax in a case where the business ceases on 31st of March 27. Just need to change that one date. And the computations will come to our way the same as above. This pro forma, I simply can copy and paste. And because this will repeat, we just need to add one more column. The first column is a column of 31st of March 2026. Then I'll go to add another column of 31st of March 2027. And obviously, I'll have to try and update the balances a little. Because when she plans to sell and transfer it to her sister, one more year the business will run. So effectively now we have 2 years to work till then. There we only had 1 year to consider. That year was itself the year of 26. And here we have got now 2 years to take it in. First one is going to be 6. The second one is going to be 7. The profits for the next year, they're telling us 6,000 divided by 12, multiplied by 12. The figure will turn out to be 72,000. 72,000. The profits have been worked. Now we will try to incorporate the effect of capital allowance. Because this is not the year of cessation now, so I will have to claim a normal capital allowance, AIA. 6,000 has been the cost. If I go to multiply 100% of AIA with that, 6,000 allowance out of which have been claimed. Okay with that. This takes the profit down to 54,000. Well, as far as this 10,000 balancing allowance is concerned, balancing charge is concerned, since the sale is being made to a connected party, succession election we will make, and under the succession election, the assets are transferred to a connected party at no gain, no loss. So neither the balancing allowance or nor the balancing charge will arise. Otherwise, just the way the balancing charge was worked in the scenario above, I would have claimed it because there the business was just seized, it was just shut down, was not being transferred to a connected party, which right now is transferred to a connected party. Sister is a connected party. So succession election is made. Under the succession election, when the transfers are made, the assets are transferred at no gain, no loss. So no balancing allowance, no balancing charge will arise. So 10,000, the market value that they're providing to us would have been the figure of balancing charge, but we have not claimed it, which means in the second year, we will not be claiming any allowance. Otherwise, the balancing charge of 10,000 we would have recognized here if the succession election was not made. And they were hinting us towards making that election over here. Yeah, I'm happy to make any elections which are beneficial for tax perspective. So that election was made. So asset is deemed to be transferred at no balancing allowance, at no balancing charge. Otherwise, succession election has been made. Which means the asset is now being transferred at no gain, no loss. And this is the profit for this year that we have been able to work it out, 72,000. Just the way we have taxed, now we will tax it for both the years separately. We will have to work the answer. So same process needs to be followed. Uniformity has to be achieved. I again will have two columns to write it exactly the way that I will manage it. So first column will have now a different amount of profits in it. And even the liability that I will go to work, this time the profit is now 54,000. 54,000. And when I will go to subtract the personal allowance out of it, the figure will turn out to be what? 12570, it's 41430. 41430. This side has got a profit of 72,000. This side will have some more income coming to our way, such as property income, which obviously in this column does not exist, but that property income will come to her way. The value is given as 52,000. Yeah, 52,000 annual rental income. And then we will come to subtract the personal allowance. Even a personal allowance requires to have a little bit of adjustment. Even a personal allowance requires to have a little bit of adjustment. Even a personal allowance requires to have a bit of an adjustment. So even a personal allowance requires to have adjustment because when ANI is more than 100,000, which in this case is the case right now, what is ANI? The ANI is going to be 72 plus 52,000. 70 plus 50 is 120, 124. So 124,000, it's definitely exceeding over to that 100,000 mark. And therefore, the allowance needs to be adjusted for the personal allowance, the limit of which one is 12570 that requires to be adjusted. How will it be adjusted? We take the ANI minus 100,000, then we multiply this by 50%, or we just go and make the half of that. That takes the total down to 570. This is going to be the balance of allowance for this year, 72,000 plus 52,000 minus 570. It's 123430. Then we can work the answer. Obviously, we have to work the answer for both the tax years combined. So I can go with the very first one, 37700 at the rate of 20%. Excess will be taxed at 40%. We're working the answer for the very first one out. What is the excess? 41430 minus 37700. It's 3730 multiplied by 40%. It's 1492. 37700 7540. So the liability here that we have got turns out to be 9032. 9032. So exactly that way we have to work the answer for the next year. Up to 37700 mark, the rate of tax is 20%. And the balancing of that amount will be taxed at 40%. Let's go to find that balancing of that amount, 123430. So 123430 minus 37700, 85730. At the rate of 40%, the figure becomes 34292. 34292. This one is 7540. So this is the liability that we have, 41. But if I have to compare it like with like, we will have to minus the income tax liability that belongs to property income. Because here we do not have a property income, here we do have. So if we've got the liability this much, that is due to the reason of this also involves the property income in. So now we can try to work the liability on property income and can subtract it. So to find the effective effect. So income tax on property business income. Let's go and do the working of it on the next page on the top. So 52,000 minus 12570. I mean, if I had only the property income to go with, this would have used the personal allowance and taken this whole thing down to 39430, out of which 37700 would have been taxed at 20%, excess at 37700 minus 39430, 1730, 40%. The figure is 692. 37700, 7540. So the total liability that we have got on property income, 8232. 8232. So this is the amount that I will go to subtract it from here to get me an effective if answer of the liability on trading profit, 41832 becomes 33600. Okay with that? So we just have completed the effect of income tax. Now we will work the effect of capital gains tax on, and then we will be able to find that post tax cash proceeds. So I will now go to make the same heading as above, and within which now I will write capital gains tax. Instead of this, I will write, so business ceases on 31st of March 26. Business, in fact, not ceases, I would use the word business sells on. Sells on. and within which the heading of income tax we had been using, now we will use the heading of capital gains tax. Capital gains tax. Okay. For this reason, I will have to write down the two things only, the building and equipment, because the goodwill will not be a part of that. The goodwill will come in second possibility. So we will have to calculate the gain on the building and equipment. So if I look back now finally into those market values, so this is the day I'm standing it on, and the market values of both are provided. 330 for the building and equipment is 10,000. So 330, at least I can take that for building. Minus the cost. The cost is given on the up or not? What is the cost of the building that I should go to use it here to get me a figure of the gain here? Well, the gain on equipment will be nothing because they have told us about this down at the bottom that all the equipment is a movable one and has a cost or a market value more than to 6,000. No item. So this will be an exempt. The disposal of equipment is exempt as far as the capital gains tax is concerned. So I will not work any gain. I will not work any loss. It's going to be only on the side of building. So what has been the cost? The cost is given as 60,000. But this business was gifted to her by his father. And the building is a part of that business. So we have to see the time that this business was gifted to her, the day was 1st of July, and the market value of this building was 300,000. That is another thing in this we have to understand. This is Zeti's father. Zeti's father, the name of that is mentioned, so I can use the name Ravi. And this is Zeti. This is the day the business was transferred to her. The day of transfer was 1st of July 2020-21. And that building was a part of that business. It includes that building. So the market value at which the building was transferred on that day was 300,000. Check this one out. So the gain in the books of Ravi was worked by using the cost of 60,000 and the market value of proceeds in the books of seller turns out to be the cost in the books of buyer. And then they both have made the joint election for this gift holdover relief. As a result of it, all the gain of the Ravi side was deferred against the cost of the building being owned by Ziti, which takes the base cost of it down to 60,000, which today when she comes to sell this off to someone, she will be using this one up there. This is where you will be technically sound on the topics involved in, you will make the use of it. Did I explain any new thing to you that you're watching me? You definitely have this feeling that this relief is pretty much known to all of you, but you have to make a use of that because this has got the marks attached to it. Specifically, they want us to make the use of some reliefs available on the way. Yeah. So that was one of the relief that we have applied on the way, which has let us all know the base cost that she can today use to calculate the gain on the closure of this business by her. This figure could have not been simply copied from here because this 60,000 is actually a cost to Ravi. How come this has become a cost to Ziti also? This whole explanation. So 270,000 has been the figure of the gain that we have got. And to make these gains taxable, I have to deduct the exemption. Provided the exemption has not yet been utilized, we'll definitely go to make a use of that. Yeah, they have not mentioned anywhere else in regards to anything for exemption. That means we are bound to use the exemption like normal. Yeah. So exemption is 3,000. And this way, we can work the capital gains tax liability, depending it upon if we can think of applying the business asset disposal relief on it or not. For the business asset disposal relief to apply, the business has to either close or cease, which definitely is the case happening now. Second condition is that the business must have been owned for a period of 2 years or more, which looks to me is also satisfying because she acquired this business on 1st of July 2021 and she is seizing it off after definitely 2 years or more. So BADR becomes applicable. You have to pen down the criteria the way that I'm calling. 2 year or more, the ownership has to be, the business has to cease, which definitely is happening. So these taxable gains, whatever we have got, will attract the PADR. So capital gains tax liability, when I'm going to work, it will be worked at the rate of 10% up to 1 million pounds. The rate will be 10%. So this is the liability that we have got for capital gains. The PADR has become applicable. So first one that we have applied is the holdover relief. And now we came to apply the PADR. Now I will redo the calculation for the business being seized on, in fact, sold. Seizes on, I will have to change the words of it to sells. On 31st of March, 2027. Okay. So here I will have to redo the whole, and one more thing will come on our way, and that one thing is going to be a goodwill for the first time because the business is rather transferred to someone who has acquired it. So in that acquisition transaction, the goodwill will arise. That's called as goodwill. So the exemption will remain at its place. The PADR might be applied, might not be applied. Only the time will tell. One thing I will definitely have to include it in is a goodwill. Equipment still not going to come. Now the value has changed. The value I'm going to use is going to be a market value of this day, which is 31st of March, 350,000. So that's going to be the difference in it. The first one. This will take the total value down to 290,000. Well, this totally will still be applied because the previous history is not changing. Previously, this business was acquired by her from her father. So this is the value at which the building was transferred to her. That story will still be applied. 60,000 base cost will still be used to calculate the gain based on the market value of this date. Well, the goodwill has no cost. The market value of the goodwill will itself be the figure of the gain, 45,000. So the total value has turned out to be 45 plus 290. 335,000. 332,000. And the rate onto that is 33200. BADR still be applied because the criteria is still being satisfied. The business is disposed after a 2 year of ownership. So the BADR is still applied. The BADR is still applied after the 2 years of ownership. The BADR is still applied. Yeah, in one case, if she goes by this way, she would sell this building to her sister for 300,000. But we have used 350,000 over here. Why have we used 350, not 300? Because sister is a connected party. And when the connected party is involved, the market value is used instead of proceeds to calculate the gain. It's a very basic rule that we learn in the basic studies of ours, and now we are applying it over. Yeah, when I will find the later tax position net of cash, there I will take actual proceeds because the idea will be there to find the actual inflow outflow. There I will take 300,000, but for the sake of computing the gain, the market value is used while the asset is sold out to a connected party, and sister of the city is a connection to a city. So we are done computing the capital gains for both the possibilities. We are done computing the income tax for both the possibilities. Now the time has come up that we go to bring it all on a one page to analyze the net of tax cash position. I can use exactly the same words that they have used. Post tax cash position. Post tax cash position. So if I go and take that first case, the first case is cessation. So if the business ceases on 31st of March 2026 and rather sells on 31st of March 2027, two possibilities we have. Here in the very first spot, I have to go and write what? The profits. That's the first thing, the trading profits. Trading profits were 60,000 here. Remember, 5,000 multiplied by 12 times. In fact, the same thing we did write it before, and we can copy and paste 60,000. But if we go with the other option, it's not just the 5,000 multiplied by 12 times, but it's also the 6,000, also the 12 times. So I will not just take 60, I will take 132,000. 6,000 multiplied by 12. It's gonna add 60,000 from here and 72,000 from here. Because if the business will run for one extra year, this will generate more cash to them. On top of 60, they will also get 72,000. Most of you, they're with me since the start of this question. In fact, all of you, maybe one or two, they have just joined me after. Please watch the whole of that first part that we have spent on answering. It's been like 1 hour since the time we are into this question. So if you're struggling to cope up with this because you've just stepped in, you can understand the reason of that why. Remember, they have purchased an equipment. So purchasing an equipment is an outflow, which obviously going to affect the both the sides since it's an outflow. When this will go to effect this year, this also will go to effect in a cumulative way this year also. Then we can go to write the proceeds from the disposal. Disposal proceeds. In the end, I will go to fix in the effect of income taxes and the capital gains taxes, the outflows. So proceeds of the disposals are the inflows. The inflows are going to be from here in the very first option, the building and equipment. Building and equipment, 330,000 and 10,000. I can write down the goodwill, building, and equipment. Goodwill inflow will not come in here. The building inflow will come in 330,000 and proceeds inflow is 10,000. The inflow values will slightly change. No, for equipment, it will remain the 10,000. But for building, if you're thinking of taking the 350, no, because this way she will go to sell off this to her sister for 300,000. So I will go to replace it with actual cash inflow, which is going to be 300,000. So while I was working the gain, I did use the market value for the sake of computing the gain. But while finding the post-tax cash position, I have to use obviously the actual cash inflow outflow. While the goodwill will be 45,000 as they've given. So clearly you can see no goodwill in the very first. And we have not even considered it elsewhere. Goodwill was only been the part of second possibility, not been the part of first case. Now I will go to fix in the effect of taxes, income tax, and capital gains tax, which obviously is going to be an outflow, which will give us in the end the final answer for us to make a conclusion which way is going to be beneficial for her. Oh, these workings of the income tax we will have to take ourselves back to. So income tax in the first possibility was 13032. 13032. 13032. While the capital gains tax was only like 26700. Income taxes in the second possibility being worked, this was being finalized after taking into account of the effect of property income tax and this one also. Cumulative effect we have to take it. Not just this tax will be paid, but also this one. So 9132 plus 33600. No, income tax is 1032. Yeah. Income tax for this one is going to be 9032. I go and take you back to my own working and encircle it. 9032 from this year and 33600 from this year. 33600. 33600. By combining the both, the income tax is going to be 9032 plus 33600. 42632. 42632. Then comes the capital gains tax. We just have worked. Capital gains tax liability will be 33200. 33200. So either they will pay this one or they will pay this one. Not you have to add the both. If the business being sold onto this date. So let's go to find the net effects of first column. The second one, 60,000 is an inflow, minus 6,000 is an outflow, plus 330,000 is an inflow, plus 10,000 is an inflow, minus 13032, minus 26700, 354,268. 354,268. The other side, I believe, will have a better position. 60,000, first of all, they will be able to make more profit. That's going to be quite an inflow, minus 6,000, same outflow. Plus 45,000, plus 300,000, plus 10,000, minus 4, 2, 632, minus 33200. It's 405,168. 405,168. So 405,168. Definitely, the net inflow is higher here. So transferring the business to her sister by delaying that by 1 year will have more better cash effect on the city. Don't consider it is a tax payment. This is a net cash inflow that she is going to have more under this way if she goes by. And this will also go to delay the payment since this is going to be a tax year 26-27. This is tax year 25-26. So the deadline to pay the tax for this tax year is 31st of Jan by 28. And for this one, it's 31st of Jan 27. So we also can see a delay of a payment of income tax and the capital gains tax liability by 1 year. So surely by delaying the sale of the business by a year will benefit her as she will be able to have better cash effect, and she also will have a little bit of a delay in making the payment of taxes, not little bit, a gap of a whole of a year. That's going to give us like 50, 17 marks. Again, the whole of the knowledge that I've applied into it, that's nothing out of what we have done in the past. Business asset disposal relief on the way has come to our way. Holdover relief has come to our way on the way. Simple gain loss computation we have done, simple income tax computations we have performed, capital gains tax computation that we have performed, capital allowances on the way that we have worked, the balancing charge. But it was something that requires to have a lot of things to consider. And if you skip the one, two things out of it, you obviously will not be able to make a right decision in the end because your figures might not gonna match in the end. Was this being required? I believe we have done it, yeah. Our post-tax calculation, we've been able to let them know, and this pretty much ends the talk of it. Okay with that? Explanation of whether or not the VAT would need to be charged on either of the both of these alternative disposals. So I can make the summary of that and then we can reveal the solution of it. So the part A2. So if I'm solving this part, VAT implications. If the business getting seized on 31st of March 26, or if the business transferred as a going concern on 31st of March. I mean, we call it in the term of VAT, business transferred as a going concern. The concern over here means an entity, a business, which is still going on. You have not closed it. And someone else will come to continue that business as from tomorrow. You just have passed it on to someone else. So the concern is still going on. So business transferred as a going concern is outside the scope of VAT. I mean, there will be no tax consequences over to. It's outside the scope of the value added tax. It's outside the scope of the value added tax. It's outside the scope of the value added tax, provided few of those conditions are being satisfied. I can write down those conditions also for your revision. The conditions to qualify are 4 of them, out of which the very first one is transferred as a going concern. Transferred as a going concern. Number 2, same trade is carried on, which is usually a case. See, if tomorrow I sell my setup to someone, the setup that I'm running of conducting the courses and all. So if I go to sell off this to someone, that setup will continue the same way as from tomorrow. The same services it will be offered because it's continued, transferred as a going concern. Not tomorrow, they will start producing some products under this brand of Learn ACCA with Ali Shafi. They will start producing some food items and then they will sell those food items. Same trade will continue, usually a case. Same trade is carried on, then no significant break in trade. Just because of this transition, the activities have not been significantly disturbed. Can happen that maybe a day or two the courses are not conducted for the day or tomorrow, and then from the third day onwards the courses will start be running after the same. Not that for the next 6 months the setup will not offer any course because there is a transition going on. Maybe a break of a week or maybe a break of a day or two during the transition was happening, and then after a day or two same is continuing. No significant break in a trade. That transition was so smooth that yesterday whatever that they are into they're still continuing, but that today no significant break in it, same services they are offering. And last thing is, new owner is registered for VAT. New owner, which right now is going to be a sister, is either registered for VAT or the registration of that owner is under process. If all of those four conditions are satisfied, the transfer as a going concern is considered to be as an outside the scope of VAT. But if the criteria is not satisfied, we will have to charge the VAT on the sale value of the assets, 20%, which right now is only an equipment. So whatever the sale value of an equipment is, we simply go to multiply it with 20% rate of the VAT to calculate the VAT on it. Which is going to be the case in it. VAT will be charged at the rate of 20% on the sale value of the equipment. Like the way you record the VAT on a transaction at 20%, you will go to record the VAT on the sale value of an equipment. Why not the building? Because we have two things to consider. Why did I answer only for equipment, not the building? Because building is a commercial building. And by the time the building is already at 3 years old, and then it is disposed, no tax consequences are applied because it is then considered to be as an exempt supply. On Saturday also, I was discussing this thing under a capital goods scheme, that when a building is disposed after 3 years or more, then the day it is being disposed is considered to be as an exempt supply, and no VAT whatsoever one has to account for. And that's been the case. This building has been disposed on the day from this, it's already more than 3 years old. So no VAT on that will be charged. Just the equipment will qualify, because this 3-year rule does not apply to an equipment. This does apply only to a commercial building. Well, for this case, I already have told you that the transfer is going to be an outside the scope of the VAT, because now if I go to reveal this whole answer, I could have talked about this thing in air, but still I have done a bit of a paperwork. If you look into a solution of that, apart from this whole of the work that we have done, same figure work, whatever you've got to see that we have worked everywhere else. See, in the end, they even have got the same tax position as we have got. It was pretty much readable, but I was wanting to work onto the computational stuff. They even have made the same conclusion that delaying the sale until 31st of March would be financially viable, and also the due date of the tax will even be delayed by the 1 year. Same way they're working the profits, proceeds, taxes, income taxes, summary of post-tax position. They're explaining the BADR 2-year rule is satisfied. So it was available in both situations. As you people can see me applying the BADR in both the capital gains taxes that I have worked. Even over here, 10%. Don't forget making the use of these headings to just separate your solution from one part to the next. And that's the income tax that we have worked, even exactly the way they have worked the answer we are also working. So going down to that part to try and see if they're writing the same or not. Yeah, the value added tax. If the sale happens on 31st of March, the VAT will need to be charged at 20% on the sale of an equipment. The sale of the building will be an exempt supply. Why? Because it's a commercial building and more than 3 years old. So VAT will still be charged at 20% unless the sale being qualified to be as a transfer of a going concern. The conditions are business must be transferred as a going concern, same kind of trade is carried on, the ZITI system must be registered for VAT, should not be a significant break. That is the knowledge. If you have it from the topic of VAT, you end up scoring 4 marks out of 5 are not going anywhere. That's exactly the same summary I was trying to sketch it up on this page. Finally, I will go to look into the requirement number B for the very first time, which was not being looked upon. Calculations of the amount of inheritance tax. So this is focusing on IHT. which would be payable by Ziti for all of the possible dates of the father's death in between. You should include an explanation of the availability of any inheritance tax reliefs, such as annual exemption, business property relief, um, uh, taper relief, all those reliefs. When calculating these potential inheritance tax liability, you should assume the ZT will sell the business on 31st of March 2026, which is the first possible way of selling the business in comparison to two. Because the second way is 31st of March 2027. The best way for you to approach this to identify the particular dates on which the inheritance liability will change. This looks to me an easier question. But they just do not want us to calculate the liability, but they also want us to calculate the liability on all of those dates where the liability balance will change. And they're hinting it towards one thing. I at least have got that hint, and you should also go to get this one out. The inheritance tax liability, once you're done calculating at the rate of 40% on the death, it is reduced by the amount of taper relief, which we know that is available into many denominations, 20%, 40%, 60%. And that is that relief which brings the liability of the inheritance tax down by different percentages. So the liability will change as a result of different rates of the taper relief that we have to apply. So once we are done computing the liability, we can write down all of those dates on which the taper relief will be worked at 20%, at 40%, at 60%, because at every percentage that you will go to apply, the liability will change. That's what they're demanding it from us. So for that reason, I will just simply have to work the answer of inheritance tax liability in the very first place. Or I would say originally. So first of all, let's go back to that section where they were telling us the same two things being transferred. The building has been transferred, and the equipment on that day standing. Yeah. Market value at the time my father was gifting me this. Market value at the time of my father's gifting it on 1st of July 2021. So we will have to find the transfer of value first. This is part B that we are trying to solve. Is it part B? Yeah. Part B does not have any subparts, just the part B. So first thing first, we will have to find a transfer of value. Transfer of value on a day the transport was made, it is definitely going to be considered as potentially exempt transfer, as the transfer of business by him to her is a pet. And the market value on the date of transfer they have given to us. Goodwill has like 40,000. Everything in the topic of inheritance tax is chargeable. So we take goodwill also in 300,000 plus 9,000. So the total transfer of value is 349,000. We will have to come and subtract those exemptions from the tax year 21-22. 21-22. Can we use the exemption of the previous tax year? No. Yes, we can. Because this is the transfer of pet. Before than that, the CLT was made long way back in. So we can definitely use the exemption of both the tax years. See, basics will come into play. There is no rocket science. You cannot expect to make mistakes over two. Basics, if you have, you will never end. You will never stop writing and will get the most of the marks out of it. This is going to be a chargeable amount. The potentially exempt transfer is exempt in the life, becomes taxable upon the death. So we have to see the day the death is taking place. So if I go to make an assumption that the death takes place on all the possible dates on which the inheritance tax liability will arise, the death has to take place within the next 7 years. And they wanting us to, they did mention the period in between, 2nd of June. So why don't we assume that the death takes place itself on that day first, 2nd of June 2025. Death is taking place on 2nd of June 2025. Whose death? Father's death, Ravi. So is the transfer being made in the last 7 years of death? Yes, as the death takes place in a matter of 22, 23, 24, 25. No, we cannot take. We can take 3 to 4. So the death takes place definitely is in the last. This is going to work the basic taper relief percentage for all of us. 22, 23, 24, 25 we cannot take because that's going to land us on 1st of July 25. Yeah. So in the last 7 years of the death, the PET is, so it will become taxable upon the death. NRB of the death is 325,000 by default. Transfers in the last 7 years. So the transfer that we will find in the last 7 years is the CLT1. So the value of the CLT is given as 190,000. And that too takes the effect of annual exemption. 190,000 will take 2 exemptions. So I will write it in the bracket minus 3,000 minus 3,000. So this value is going to be 184,000. Basic thing. Sometimes the question that the examiner asks makes the life of the student difficult, and you don't get to know that what they're demanding. But this is what they were demanding. They are wanting us to calculate the answer of the liability in the very first place, which is what I'm doing. And then I will have to write down the taper relief. IHT at the rate of 40% is going to be 8080. Taper relief will have to come and reduce this. So the first possible way, the first date that I did choose to take it is the one that they want me to consider it. 2nd of March. Where is the requirement of the question? 2nd of June. They wanted me to calculate the inheritance tax. Possible dates. So the first possible date that I have made an assumption of that he died on was the date they have given to us itself, 2nd of June. And then the next possible date is going to be the date on which the taper relief ratio will change. At least on this date, the taper relief is going to be applied at its basic 20%. So 8080 will bring this down by 20%. That's going to be, 80800. The 20% of that is going to be 16160. 16160. So this is the answer that I've got. The first possibility. 64640. So I can write that if the death is on this date. Now the second possibility is that I can assume that if the death is on the second possible date on which the taper relief percentage will change is can be 31st of March 2026. Or sorry, I can use the 30th of June to be the end. So I can take the first date to be the 30th of June 25. Please analyze it with me. This is the date that I already have taken. So if I go to land myself on the first 30th of June 25, will the taper relief ratio will change? No. No, the taper relief ratio will not change. And if I go to take 30th of June 2027, will the ratio of the taper relief will change? If the date will become 30th of June 2027, the gap will become how long? From the date of transfer. So if the death takes place on 30th of June 27, the gap is going to be 22, 23, 24, 25, 26, 27, 6 years. In fact, we can take it. We can take the death takes place on 30th of June 26. If the death takes place on these are the three possible dates that I can write. This is going to be 7, this is going to be 8. 7 and 8. So IHT liability before taper relief is going to be the same as above, 8080. And with the taper relief will probably become, just need to copy and paste the term of taper relief. So it's going to be 4 years or 4 to 5. 4 years, 3 to 4, 4 to 5. 21, 22, 22, 23, 24, 25, and 26. So it's 4 to 5 years. So at 4 to 5 years, we are going to use 40%. This will definitely reduce the income tax liability from the first possibility that we have worked above. Here, the inheritance tax liability will be worked at the rate of 60%. And finally, here we will have to work this at the rate of 80%. So by considering all those possibilities, this will go to change the liability balance at each year end. Because the question does not tell us that actually the day that he dies. They want us to assume the possible dates of his death. So the first possible date was in fact the 2nd of June. The second possibility could have been 26, 27, and 28. Yeah, rightly so. So we have used those 40, 60, and 80% ratio. The answers we all can work. This was the thing that this question was requiring us to answer. And basically, the main thing in this question was to repeat that process of taxing the transfer, the way that we tax it in life, the way we tax it upon the death, and reduce it by the amount of the relief of taper. The basic one is 20%, and then with every 1 year extra passing, the ratio will extend to extra 20 into it. A comparison of income tax implications of for ZT of investing 25,000 in either EIS shares or VCT shares in tax year 27 as requested. So again, I can make the summary of this whole solution before we can read it. This is EIS and three possibilities to look under. What is the tax relief of investing into EIS? Second thing, dividends if we get from EIS investment. And last thing is the relief. So exactly in a way, I can write the VCT on the same page. What is going to be the saving of tax? So for venture capital trust, the dividends are fully exempt. Whereas for EIS, taxable. Tax saving is 30% multiplied by the cost that they have subscribed. So this way, 30% of 25,000 is going to be 7,500. So this is going to be income tax reducer. Income tax reducer. Income tax is reduced by 7,500, which is going to be the same for VCT. I just need to copy and paste this whole thing down below also. So as far as the tax saving is concerned, there is no difference. There is no difference. Yeah, the difference comes in the dividends. The dividends are exempt for VCT. So in case the relief has not been fully applied, we have an option to carry the loss back, option to carry back to one only year, to 1 year, to only 1 year. No option to carry back. So this knowledge, if I will have it, I will be able to X myself on to get me marks. Like 4 marks, I just have to get out of that 2 marks on EIS, 2 marks on the VCT. This question does not have any significance in it. By the time you get towards to that closing part of this question, the parts they become more and more for small weight. Major marks you get out of it from the part A, and even the ratio of the marks keeps on diminishing as you go towards further down to end the question. If I go to look into the solution of that, that was the solution of inheritance tax, the way that I have worked those answers, even those possible dates of debts, and the basic computation of inheritance tax in the first place. See, that's the basic computation that I even have worked. And these are those taper relief liabilities that we could have worked. Yeah. Tax efficient investments. Income tax liability would be reduced by 30% of the amount invested in VCT, 7,500. The tax relief for the EIS is going to be the same. So income tax relief is same for both. Yeah. EIS shares dividends can, the relief can allow us to carry back to one last tax year. Dividend income from VCT is exempt, while for VCT, it is taxable. In the bullet points, the same as I have explained, you can see that this way these schemes are testable and these are supporting marks. Without being troubled or without being looking back into the entire story, we just can answer this part by just looking into that one particular thing. That particular thing was this, this. I mean, for this part to solve, we did not need to read the entire exhibits. And 4 marks are good ones, and these can be the supporting marks that may become the reason of crossing the 50 marks barrier. And finally, the issues arising and the actions we should take as a result of cities plans for the HMRC payment. I already have answered a question of this kind the other day, and I can still answer it. The issue was that they have received 5,000 and they were too happy that they have received it, that they do not want to even disclose it. But it is their error, so I'm going to keep the money. They were in this thought that because they have received it, and in case they are unable to determine the possible reason behind, then they will keep it with them, because by saying that this is their fault, if they have given to us, that's their mistake. Now we have it, this is ours. This is what they're up to. I have recently received 5,000 into my bank account from HMRs. I do not know what it relates to, but it is their error, so I'm going to keep the money. So first of all, we have to try, being a tax advisor or tax consultant of the city, we will have to advise the city to investigate the possible reason behind getting this 5,000 from HMRC, that on which account did they receive it? To what item it relates to? They need to investigate it in the first place. If they are unable to determine the possible reason, you should advise the client to disclose it and repay this back to authority at earliest, so not to face any penalties for the late payments. Yeah, you can ask the city to do that at her own, or the city can authorize us to do it on the behalf of city. But we have to take a permission from our client to directly contact the authority in regards to it. Otherwise, we cannot do it. We just can let the city do that, but in case the city authorizes us to do that, then we will do on the behalf of city. If the city is not in a sense of, in a mind of refunding it back to authority, what we should have to do as the tax consultant of city, because we have done our best to convince the client to go and return this amount back to authority, the client is refusing to. So what we should do in this regards to safeguard us, resign it from assignment and inform the tax authority that we're no longer acting it as a consultant of this business. You may not need to give the HMRC the whole reason of that, why you are resigning, but at least let the HMRC know that you're no longer acting it as the consultant. This is the kind of an answer that I was telling you the other day, that by using your practical exposure that you have, you just have to give it, you have to throw an answer to your examiner with the expectation of getting 2 marks even out of 5. That's going to be the plus. But leaving a space blank is not going to give you nothing. To get something, at least you have to give it a best shot. Whatever you can write it about. I mean, whatever I have just said, it's a very casual talk. And you can understand that by being an auditor, by being a tax consultant, by being a firm, you have to work in the best interest of client. But on the other side, whatever the client is doing some mischievous acts, have to warn the client and the consequences of. And in the case the client does not want to listen to, resign. Take yourself out of it so that later you will not be penalized. Your firm should not get a license being cancelled off yours just because you've been involved with the client in doing this tax evasion. This is what you're going to read it in the answer. We should investigate the city's tax evasion to determine what? A reason for that. If we are unable to identify the reason, must be disclosed and repaid to authority at earliest. ZT can inform the authority himself, or he may authorize us to do on the behalf of ZT. However, we must not disclose the error to HMRC unless we have a permission from ZT. We cannot bypass and start talking to the tax authorities directly. We cannot continue to act for ZT unless the disclosure is made. If ZT refuses to notify, cease to act for him and tell the authority that we're no longer acting it for him and not need to give any reason. The tax evasion, so this could result into a criminal proceedings under both the tax and money laundering legislation. So it's a very generalized answer that has got nothing to do with your tax syllabus. A question you will be asked to in section A of the exam, and you should be ready to get that kind of a question, and you should be flexible enough of writing. That's the reason why I told you that you must have to perform a section A type question afterwards, because by this time you already have done section B. and you almost have done the main thing out of section A type question, and you are about to end this out, and probably the clock is running, 5 minutes are left, and you have got this part to write yourself in. So you will write it whatever you wish to, because you already have completed your exam by attempting section B type question, by attempting the major part of this question. Part A was the major one, and part B to some extent was also a major one. And you're left out with part C and D. Now, part C is the one which obviously you have a dead sure about the knowledge that you have. You know EIS VCT. So you know that you're getting 3 marks or 3.5 out of 4 marks definitely on it. But this is the kind of a part that you are left up probably 2 minutes on the clock, 5 minutes on the clock. Rather to sit there and don't write anything on, you can give it a thought. With the expectation of getting 2 marks out of it, 3 marks out of that, that's going to be a bonus. So section A type question, like I said to you, takes like the long time, 1 hour, 45 minutes effectively spent on just to complete one more section A type question. So quickly, we will take ourselves down to one question, the name of which one is LIBOR, so that we can finish it off in a matter of 13 and next minutes. And then we will be on the corporates right afterwards. I told you that either of the two I will work. I'm deciding to work the LIBOR because I find that question to be a better one. So this section A type question is gone. Either of the two we could perform. I'm working the LIBOR. While this we will not, because we have to also now take ourselves down to companies. 2 section A type questions are lined up for company, and 2 section B type questions. This obviously has been taken from your practice kit of yours. You can open the practice kit of yours and later you can review it. But I can work the LIBOR for you, which was being tested back in December 18, page 70, that this one is on. Let's open it and try to finish it at earliest. Section B type question, you know that has got the one exhibit. That one exhibit is in fact the whole scenario. And this is the requirements, which you can open and copy and paste it to the response option, just not to open it ever after. And the requirements are so easier here, divided into 2-3 parts. Each part will have 4-8 marks in. Part A has got 2 further marks to get. Part B has got a different 8 marks question in. We can give it a look to it. In fact, we can read the requirement first, and then we can solve. That is a board explanation. LIBOR. Okay. Explain with supporting calculations. Typical questions of the section B type are always going to be like explain with supporting calculations. The capital gains tax implications for the LIBOR of takeover of Vulcan Limited by Mercury PLC on 1st of June 2025, and a subsequent sale of his Mercury PLC shares on the 1st of Jan 2026. So they have involved mainly the takeover. 8 marks. Explain with supporting calculations why would it be beneficial for LIBOR to sell his Mercury PLC shares instead of. So actually, it's the same thing, continuing it into the next part. Well, part B is going to be on something else. We will look into that afterwards. You should be assuming the due date is 1st of September 2025. Fine. LIBOR and his sister Vesta, they're required to have an advice on not many things. So the two parties are involved, LIBOR and Vesta. The timing of the sale of the shares acquired by LIBOR in the recent company takeover, which is in fact the part A. Capital gains tax and inheritance tax consequences of Vesta making a lifetime gift. This is part B, which we have not yet even looked into. So LIBOR is a UK resident and domiciled. Taxable income, 30,000. Acquisition of ordinary shares in Mercury PLC, 40% hold, 800 shares, 40,000 back in 2020. Mercury PLC acquired 100,000 share capital of Vulcan on first. Now, this is a takeover. This is a takeover. And as a result of it, four shares were received. The value of each share was £20, 7.5 cash. This has been the total issued share capital of Mercury. Liber has never been a director or employee. So this is hinting us that the BADR is not applied because the person has never been a director or employee of a company. The takeover was a bona fide commercial reasons and not for the avoidance of tax. Liber, proposed transaction in Mercury PLC shares. Liber now wishes to sell all of his shares to Mercury. In Mercury, he has received an offer from an unconnected party to purchase these shares on 1st of Jan 26 for £28. Liber would prefer to sell these shares to his nephew Janus. However, this would delay the sale as the nephew will not have got the necessary funds to pay. The transaction will execute on. So if the sale is being made to nephew, the sale transaction will take place a little while after. But if the sale is being made out to an external party, unknown party, sale transaction will take place on 1st of Jan 26. Janus will sell the shares for £28. So may the sale of the share takes place to a unconnected party or to a nephew. Price will be the same as above, £28. Well, this looks to me for the second part. Yeah. So we will look into the Vesta case for part B later on. So this is tested onto a takeover. And to understand this one out, we have to go by this way of making the picture of a takeover. Part A, if I'm solving, told you that by using the question, you have to copy and paste the heading of it. Capital gains tax implication for the liable of the takeover. This is the heading that you have to make it in, and then you start working by making that picture. This is actually the shares were held in which company? Vulcan Limited. So the first company is V Limited, a company in which the Liber is a shareholder by holding 800 shares at a price of £3,200. No, £40,000. £40,000. And the date of purchase is 1st of July 2020. 1st of July 2020. Mercury PLC acquired the 100% of the ordinary share capital of Vulcan Limited. So this company was acquired. The day of the acquisition is given as 1st of July 2020. Being a part of the consideration. No, 1st of June 2025, sorry. 1st of June 2025. June or July? June. 1st of July 20. So a consideration that will be received in the form of shares. How many shares would they be receiving? 4 shares at £20 each and a cash of 7.5 for each share. Yeah. So we will have to find the terms of the offer. Starting myself off with the shares and the cash. For every share that she will be getting four, so the number of shares are going to be 3,200. For every share, the price is £20. The total market value of the consideration is gonna be so 800 multiplied by 4 multiplied by £20, that's 64,000. For every share, they also have received a cash payment of £7.5. So the total cash consideration is going to be 7.5 multiplied by 800, 6,000. The total market value of the consideration is 70,000. The market value is 70,000. We have to split this off into two parts. The cost that will belong to cash, the cost that belongs to shares, the cost of existing share will become the cost of new shares. Because against these shares, wherever these was being acquired, they have been able to get this much of consideration. So the cost of that one will be assigned to the cost of new consideration. But this needs to be allocated. To allocate that to the share side, we must have to take the market value, which is 64,000, divided by total market value, multiplied by the cost that we are trying to allocate, which is 40,000. So 64,000 divided by 70,000 multiplied by 40,000, it's 36571. Provided the calculations have not been an issue, 36571 minus 40,000, this much will be associated to cash. 3429. Did I work the consideration all fine? 7.5. Let me once again come to check. 7.5 in the form of cash. For every one share being held, 4 shares were to be issued. So 800 multiplied by 4 times multiplied by £20. Yeah. And 7.5 multiplied by 800. Good. The cash portion becomes immediately chargeable. Which day the takeover takes place? That day is the day we will go to charge on 1st June 2025. Gain on cash consideration. The figure of the gain is needs to be worked. We'll take the proceeds. The cash proceeds are 6,000. The cost that has just been allocated is 3,429. So this is the gain that we have ended up working. When is the day he's going to sell? So the day that he's going to sell, wishes to sell, he will receive an offer from an unconnected party to purchase the shares on 1st of Jan 26 at the price of this. The 1st of Jan 2026 is the day the shares are going to be sold. Gain on shares disposed. $6,000 minus 3,429. 2,571. We'll take the proceeds minus the cost equals to gain. The proceeds are £28 for each share she will receive. multiplied by 3,200 shares being disposed, because that's the number of shares that she owns. And when she comes to sell this off, the price for each share will go to get is £28. 89600. Well, the cost we just have allocated 36571. 36571. 36571. 53029. So if you look into the day of disposal, this disposal transaction belongs to a tax year 2526. This one even belongs to 2526. So this makes me to calculate the total gain for this tax year. I will take 2571 from that side. And will add 53029 from this side to get me a total figure of gain. 2571 55600. And then we will come to subtract an annual exemption, which is 3000, to make those gains taxable. And once the gains have become taxable, minus 3000, 52600. The BADR is not available because the person was, first of all, although the shares can be quoted and unquoted, that's not the worry. The percentage has to be by 5% or more. So Mercury PLC has got this much of shares in issuance, and she was owning like 3,200 shares after the takeover takes place, which I believe is not the 5% of this one. Like 3,200 shares is gonna be less than 5% interest. Surely 3,200 divided by 200,000, that's like 1.6%. It's like 1.6%. This is less than 5%, and that person does not even work for it. This person has got an income of 30,000. So if I will go to calculate the capital gains tax liability, I will have to tax the 7700 at the rate of 10%. Excess will take 20%. So how did I get this 7,700? That's the basic thing. I believe you people have guessed it. I still can explain. See, the band limits are 37700, out of which it's the income of that person that has utilized this band by 30,000. This 30,000 is the income that the question has provided. So we only can use this much for capital gains tax. Any amount that falls above will be taxed at 20%. So it's all the knowledge of computations and the pro forma. If you have, you will only be able to excel it. The most of the marks out of each part are depending upon the technical knowledge. So this is going to be 770. The 20% of that is going to be 8980. And the figure turns out to be 975. Figure turns out to be 9753. So we will keep this answer in safe, and that because we have to come and compare this with the second part. We are over to part A1. Now we are heading ourselves down to part A2. See, the part A1 was explain with the supporting calculation the capital gains tax implication for the liability of the takeover and subsequent sale of his shares on 1st of Jan, which is what I have achieved it. Now they want us to explain with supporting calculations why would it not be beneficial for a liable. Why would it be beneficial for the liable to sell his Mercury LC shares on 1st of May 26 instead of 1st of Jan? So we will go to sell these shares to Janus. the nephew, and see if that one is beneficial to the LIBOR or not. So the same process in the past will be there. I just have to come and revise these computations quite much the same as above. Gain on cash consideration will be the work the same as above. Gain on cash consideration. When is the day the disposal transaction is taking place? 1st of May. (2020). No, that sale took place actually. This is the date of a takeover. 1st of May 2026 instead of 1st of Jan. So I have to write it as 1st of May, which is all the way is going to be another tax year. This is tax year 26-27. So this is the difference. Now you will see it. I will not go to merge the gains, and annual exemption will go to exhaust the gains of this tax year. No capital gains tax liability will be paid. While when I will go to compute the disposal of shares later in the next tax year, the computation will be performed the same as above, but the gains will be assessed into another tax year. Yeah. With the deduction of annual exemption of 3,000, the taxable gains will become what? 53029 minus 3,000, 50029. And when I will go to calculate the capital gains tax liability on it, same story will repeat. So up to 77, the rate is going to be 10%. Excess will take 20%. What is going to be an excess amount? 50229. 50229 minus 7,700. It's 42329. At the rate of 20%, it's 8466. Eight five four two. 8542. No, 770 plus 8466. It becomes 9236. So this is the liability that we have worked under this arrangement. With the liability being worked. The price is going to be the same. Just the delay in the sale will delay the payment of tax. Also, reduce the liability. Otherwise, the liability was 9750, which now has been dropped down to 9236. So you also can find the reduction by comparing the two. A difference of 400, 500 pound that you can see in it is because of the reason of the when both the disposal transactions are taking place in two different tax years, the gain on the cash consideration has become exempt because of annual exemption had exhausted that one out. And the sale transaction takes place in the next year. This will delay the payment of tax to next year also, because this has fallen into another tax year and also has reduced the liability by 9236. It was originally 9750. It was originally that has turned out to become 9236. That was being required. So if I look into the solution of that above, So this is the answer that we have worked now. And tax relating to the sale will be made due by 1 year after rather than this. So that's the first benefit that they will get. The liability payment date will become a year after from the actual scenario. See, these are the two figures that we even have got. 9750 was originally there, 9236 that we have just worked. This is the overall saving of tax that they will go to get. And explanation wise, the calculation for the gain on the sale of mercury will be the same, but the sale will be in the following tax year. So the following tax implication will arise. The gain on the cash received on the takeover will be covered by the annual exemption amount. So no CGD will be paid in tax year 25-26. As you can see, in 25-26, no tax was paid as this has been exhausted. So this needs to be explained in writing. If you have worked this one out and if you know what you have done, you just simply have to explain it the way that this examiner is explaining. The whole of the 27 exempt will be available to deduct from the gain on the sale of shares. This will result into a capital gains liability of 9236. The overall tax saving if the Mercury PLC shares are sold on the 1st of May 6 is therefore 514, which was being compared with the actual answer to the one that we have worked. Exactly these two are the figures we are done working. 9236 now to 9750, which was being worked in part A1. And that's the solution of part A1. This is the way they've got the 9750, even the way that we have got. BADR is not available, and they are writing the reason of that. Why? Because it's not a director employee of a company and holds the shares less than 5. So I was explaining to all of you this being the part of this answer. This is the cash. BADR again is not available because not a director employee. So we are over to this part, which was the main part, which will gonna give us like 8 plus 4, 12 marks and some professional skills marks to be applied to. Overall, 15 marks are easily achieved. Advise the Vesta whether or not there are any capital gains tax implications or inheritance tax advantages for herself or for Janus. If she were to gift an investment property to Janus on 31st of December 2025, rather than leaving it to him in her estate. Okay, so they want us to answer both the topics together and advantages for herself and for Janus. So we have to answer from the perspective of the LIBOR and also from the perspective of Janus of the gift that has been made now in the life rather upon death. If she were to give the investment property to Janus on 31st of December 2025, rather than leaving it till the death. So we will go one by one capital gains tax implications. I can explain first and then inheritance tax after. For that reason, we also have to come and read that part of the question that so far we have not read. Vesta is 66 years old and has never been married or had a civil partner, is in the ill health and is expected to die at some time within a tax year 2006 and 7. He made no disposals for the capital gains tax purposes in the tax year 25-26. Okay. And will not make any in even upcoming tax year. He has made one previous lifetime gift to her son on 1st of Jan 2025, which is obviously a tax year 25-26. Vesta owns an investment property. Now, this is the real thing coming. Vesta owns an investment property, which has never been used as a private residence. The current market value of the property is less than the price the Vesta paid for it. And its value is expected to fall further throughout the tax year 2006 and 7. Current market value is less than the price the Vesta paid for it. It means the price has fallen now. And it is expected to fall even further throughout the tax year. So with every year passing, the price is diminishing, reducing. Vesta is considering gifting the investment property to Janus in her life Rather than leaving it to him, Janus is the sole beneficiary of Vestas estate. So think I can explain this to you, this part, by going with the capital gains tax implications first. The first possibility is um, investment property, gift of investment property, gift of investment property in life, which means the day of that is mentioned as 31st of December 2025. And gift of investment property or gift of investment property upon the death. Two possibilities are there, and we need to compare it. Gift of investment property upon death. And the death transaction that there is when the day is mentioned. Yeah, they have mentioned it. No, they have not mentioned this, like ill health expected to die at some point of time in tax year 26/7. So the day of death is not mentioned, but soon that's gonna happen. So imagine, as far as the capital gains tax implications are concerned, hypothetically, if I go and make the use of those figures, let's suppose the market value is 9,000, the cost is 11,000. This is the loss that we've made out of it. Now, why do we have to make a loss? This is the side of the Vesta, and this is the side of the Janus. Vesta, and this is the side of the Janus. Proceeds in the books of seller turns out to be the cost in the books of buyer. Why am I creating a loss over here? Because they told me the current market value of the property is less than the price the Vesta paid for it in the past. So whatever the cost that the Vesta has paid in the past, the price of that today is lesser. So upon the transfer of it to someone, she will be able to make a loss out of it. So this is the reason why you could see me creating the loss, right? Because the price, whatever was paid by Vesta in the past, whatever it was, market value of that has to be less than to the cost that was incurred in the past. So I randomly assume 9,000. Losses are usually allowable. We come to offset it against the capital gains of the same tax year. In case the losses are not relieved, we go to carry them forward. But the problem is that has made no disposals for the purpose of tax in this tax year and incoming tax year also. So when she will not have any gains ever, will she be able to relieve the loss? No. I can write it. This loss is unrelieved. Or I can write the word will not be relieved as no disposals in tax year 25/26 and also 26/27. This loss will not be relieved. It's a waste. If the same situation we will be in on the death day, what if the property is gifted rather on death instead of the market value will fall further. So I can now assume the market value to slip down to 8,000 now, because they're suggesting that the market value is expecting to go further down. So on the debt, the market value has gone further down to 8,000. 9,000 it was, becomes 8,000. proceeds in the books of seller turns out to be the cost in the books of buyer. Now the 3,000 loss that we have, can she do anything about that? Not to be relieved. Will not be relieved. My answer is going to be the same. Will not be relieved. As what? Why we are not going to relieve? Because there are no capital gains tax consequences on the death. Have you ever computed the capital gains tax on the death of a person? You don't. IST is computed, that tax, the CGT is not. So if she holds that property with her and transfers it on the death of her own via will, that transfer is exempt for CGT. IHT will be imposed on, capital gains tax will not be. So that 3,000, the figure that now you can see to be a negative one, is in fact 0, exempt, useless to have a loss. So either she makes the transfer now to have a loss, she makes the transfer on the death to have a loss. Both will result into same proposition, as she will have no capital gains tax consequences to bear. She neither has to pay capital gains tax, she neither have to save it, because she cannot have any gains to relieve her losses. This loss, arithmetically, we have worked, but effectively it means 0, because on the date of the death, the capital gains tax computation cannot even be performed. So she makes the loss this way or that way, effectively means no capital gains tax consequences will arise. So she will be indifferent in order to make a transfer of assets now or later on. She'll be indifferent, because when you have two things of the same kind, you find it difficult to make a choice out of it. Sometimes you go to buy a clothing item from a market and you are liking to have the two. You are confused about which one to go by, because you have to at least buy either of the two, not the both. So you become indifferent, inconclusive, indecisive about which way I should go by, which item of clothing should I go to buy. Can be in the food product. Sometime when you are hungry and you feel like having it something, but you're still indecisive about to have this meal or that meal. Same is gonna be the case over here. Either she makes the transfer to Janus now, or hold it till the day of death and then make the transfer of that on the death by a will. Ultimately, CGT will have the same effects, which will have no effects. But as far as Janus is concerned, he will be in a position to decide what's better for him. I mean, if I talk about from the perspective of Janus, this option is a preferred one. Ask me why. Because this will let him have a higher base cost, 8,000, in comparison. Sorry, higher base cost is here. Sorry. I thought 7,000. So from the perspective of Janus, this proposition is better, because the higher the base cost he will have, he will be able to use that higher base cost on the later disposal of this asset to have lesser gains, which will become the reason of saving a tax. Same asset, the Janus is buying for 9,000, which in this case is buying for 8,000. So tomorrow when this asset will be sold by the Janus to someone, Janus will be able to use this base cost, which is a high one, which will reduce the gain. So as far as the Janus perspective is concerned, having a transfer of asset to him in a life is a more preferred option, because this will result into more high base cost for him, which tomorrow he will be able to use it to reduce the gains by that amount, and taxes will be saved. But as far as the investor is concerned, she will be indecisive to do what, because in either of the ways, ultimately, no capital gains tax consequences she would ever possibly bear. This is when you are knowledgeable, You can even tackle the questions of these kinds. You can sketch up the whole story in your mind and can answer and can write it about. And you get marks. 8 marks. This question has 4 marks for capital gains tax, 4 marks for inheritance tax. I also can talk about the inheritance tax in a while. So if I go to look into the solution of it to see if the same is written or not, or in a manner the same is written or not, Vesta, capital gains tax and inheritance tax advantages. CGT, they have taken it first. Inheritance tax, they have taken it after. See if they are using the same sense that we have developed. If the property remains in the Vesta state on the death, there will be no capital gains tax implication because we don't calculate the capital gains tax on the death. If the property is gifted to Janus now, an allowable loss will arise. However, the Vesta will make no disposals for capital gains tax purposes in tax year 6-7. She will not be able to relieve it. That's the point I was discussing. Therefore, for capital gains tax purposes, Vesta will be indifferent as to whether to give the property now or leave it till the death. However, Janus base cost of the property and the future disposal is the market value at the time the property was transferred. Accordingly, the property is expected to worth less at the dates. It will be advantageous from the Janus point of view if Vesta gives the property to him now. This is the same conclusion we even have drawn, and now you can beat it. I mean, this much skills at this level of advanced taxation is required, that the knowledge if you have, and if this knowledge needs to be explained it in a way of writing, you even can write. Rather focusing on the performer of computation, you will be flexible enough to write. It's not that they've asked us to define something and you're writing it down, the definition of this topic and that topic. You're explaining the knowledge, the sense that you have in writing part, and you can. Now, for inheritance tax is concerned, if the gift is made now, it will be considered as potentially exempt transfer. Because transfer in the life and made is called as PET, which in the life is exempt. No tax consequences in the life would ever come. But taxable upon death, if the donor dies within the 7 years of making the transfer, which is expecting to be dying. Yeah, expected to die. So it will become taxable upon death at the rate of 40%. The taper relief will be applied and all. The taper relief will not be applied because taper relief comes to the way when the gap in the death and the gift is like 3 years or more, which is not going to be the case because he's expecting to die soon. So the taper relief won't come in. Yeah, if this is the day the gift was made and he is dying in this tax year, then the death is gonna come in like 1 to 2 next year. So the taper relief will not be applied. IHT at the 40% rate will be worked. If she holds the same asset till the death, this will become the part of death estate and will become even taxable at 40%. So again, as far as the inheritance tax is concerned, she will be indifferent because by holding it now and passing it on to Janus via will, it will become a part of death estate and will become taxable being the part of death estate at the rate of 40%. But if she makes the transfer of it to Janus now, there will be no immediate tax consequences because this is PET. If this PET becomes taxable upon the death later on, the rate of the death is still going to be 40%. Taper relief will not be applied. So, I mean, the effects are going to be the same. Yeah, it's just going to be the value that can differ. The death day value is different from the value of an asset now. So only while this will become the part of death estate, it will be included at a different value in comparison to if we consider this to be as a pet today now. That's only going to be the difference. But otherwise, the same rate of tax we have to apply. Taper relief will not be applied. Annual exemption still, the annual exemption will not be available because this might be exhausted by the transfer in the past. Yeah, annual exemption will not even be available because this will come to exhaust the annual exemptions. So if the property remains in the Vesta state, it will be included in a value If the property is gifted to generous now, it will be a pet, which we know that no immediate IHT will arise on that. The pet will become chargeable as a result of vested death within 7 years. So you may include that being the part of death estate. You may include that being the part of pet becoming taxable upon death within the 7 years death. Ultimately, both will result into same. Annual exemption will not be available because this will be exhausted by the transfer being made on the 1st of June 2025, as I was doubting. Yeah, this will go to exhaust the annual exemption of 25-26 and 24-25 also. Taper relief will not even be available as the Vesta will not have survived for 3 years after. So even for IHT purposes, both the Vesta and Janus will be indifferent in between making the transfer now or leaving it till the day of the death. So it's nothing, it's just the knowledge of the topic when you have. The question can ask to write the full and explanation part, and you have to use your data to talk about the annual exemptions, to talk about the taper relief, to talk about the death rate of tax, to talk about the rule of pet becoming taxable upon death within the 7 years of death. All just needs to be thrown towards your examiner to be able to get your marks. For capital gains, I already have explained it to you. The section B type, in a matter of 30 odd minutes, we have finished, not 30 odd minutes, I would say 45 to 50 minutes, we have finished this one off. And by spending enough of a time on individuals, we can take a shape towards the corporate tax. The time that we are left today, we can fix in the section B type question of corporation tax. Tomorrow, when we will go to meet, we will work section B type question. In fact, tomorrow, the course, I can work the two section B type questions on the corporates. The section A type, sorry. Because in the corporation tax, section A type question is the one in which the group aspects are tested extensively. Consortia, 75% group relief group, capital gains group, 51% group companies, claiming, surrendering, and all of the other topics of corporation tax. But based on the given time that right now we have, we can take a section B type question so that we can also wrap it up and can meet all of us tomorrow fresh to attempt the two section B type questions. I can keep it for tomorrow. Section A type. I'm calling it section B type again and again. Section A type. Unlimited and Dilip group. We can keep it for tomorrow. Section B type. Either of the two we can work. We can do the Lisa first. Right now. 134 is the question. Most of the content of the corporation tax we know that are from the individual side. Mainly, the content that belongs to corporate is the group aspects, which is from where most of the things will be tested out. If the corporates, they come to your way in section A type, B type questions. Well, the topic like capital allowances, the way that you work for individuals, almost the same way you work for companies. The capital gains, the way that you work for individuals, the same way that you work for companies, except the indexation allowance becomes the part of company side of gains. Property income, the way that you work for individual, the same way you apply to companies. And the other topics, the losses, the way that the losses are relieved, pretty much the same way the losses are relieved for the companies, terminal losses, current year carry back relief, 12 months. The main difference comes in is in the discussion of group aspects, which is where these 4 to 5 questions that I have planned will be focusing a lot on. Two section B type questions and two section A type questions. And to start with, the Lisa brings in to bring in all of us to that question within which we have the group structure. So let's get into it. Okay. The question is not as difficult as you may have been thinking of. As you know that the section B type question has always got the one long exhibit, one scenario. You should be assuming the today date is 1st of June 2025. Lisa requires to have a detailed advice on the available rollover relief, capital allowances on the purchase of building, and the group registration for the purpose of VAT. Three things they have asked. And that's the reason why there are three requirements. Calculate the chargeable gain on the sale of building one, ignoring any potential. So this question just requires us to calculate the gain without even being assuming if we have to calculate any gains, any reliefs, if we have to apply. In relation to claiming the ROR in respect of disposal of building one, explain which of those companies in Bar and Hope Limited groups are and are not able to purchase the qualifying replacement asset and state the period which such assets must be acquired. Such an easy part. Half of the marks will be required, or I would say 3 marks. We have to just come and explain the definition of 75% capital gains group in it. And then after defining, we have to apply it to the picture that they have given. And then the dates of when they can invest in so to get the rollover. So remember that qualifying period of investment 4 years, 1 year before the date of disposal, 3 years. That is what we have to write it in. Explain with the aid of supporting calculation the additional amount that would be needed to spend on qualifying asset in order for a maximum amount of gain on the building one to be relieved by the rollover. Okay, so this question is going to take us back to the revision of rollover relief. Okay, so let's focus on reading it out. Lisa's business interest, which have not been changed for many years, are set out below. So Lisa is an individual. And has got lot many interest in Bar Limited, Pumal Limited, Ring Limited, Bot Limited, Hoop Limited, Ribbon Limited. All the 6 companies are UK companies. With 31st of March, the year ends. All the minority holdings are being owned by individuals, none of whom is connected with Lisa or with each other. So this group definition thing, we will do that in another part. The first part was just there to answer the chargeable gain on the sale of building one. Chargeable gain on the sale of building one. So let's go to calculate part A1. We'll start off with proceeds. The date the sale is made it on is 31st of May 2025. 31st of May 2025. The proceeds are given as 860,000. So Bar Limited had purchased the building on the 1st of June 19 for 315,000 plus the legal fee. So they have provided us with the cost of acquisition. The legal fee is called as incidental cost. So with acquisition cost, we will top this up in. The acquisition cost is 315,000. The legal cost is 9,000. On 5th of June 2019, Bar Limited had carried out the work on the building's roof at a cost of 38,000 in order to make the building fit for the use. Now, this is very important word. To make the building fit for use. So these repairs are called as initial repairs. And initial repairs cannot be expensed out. They are rather capitalized. So I will go to add this in as a cost of extension. Or I can just name it as initial repairs. It becomes a part of the cost of that building. On 14th of July to 1st of July, we spent like 40,000 on repainting. Repainting is a revenue cost, cannot be capitalized to become the cost of the building. Bar Limited used the building one for trading purposes apart from the period from 1st of Jan 2021 to 30th of June. So for how long it has been used for the purpose of trade and for how long it has not been used, that does not really matter while computing the gain. This figure is usually called as unindexed gain because then we come to subtract the effect of indexation allowance. But unindexed gain will not come into our way. Why will it not come into our way? Because 860,000 minus 315 minus 9 minus 38, the figure is 498,000. 498,000. See the date the asset was disposed. See the date the asset was purchased. Both of these dates are post December 17. And the indexation allowance will not be worked. Indexation allowance is worked when an asset is purchased before December 17 and disposed after December 17. So you still work the indexation from the date of purchase till the December 17 mark. But if the asset is purchased even after, so indexation allowance whatsoever will not even be worked. That's the reason why in this entire question, they have not even provided us with any indexation allowance factors and all. So this answer is the full and final one. And you already have got 3 marks out of it. See if they've got the same answer down below or no. Yes, 3 marks just to get this from that. Let's get ourselves into part A2, which is about defining the group structure. And we can do that. Conveniently and easily we can do that. So 75% capital gains group. The definition of that one is a case where the direct interest have to be 75% or more and the indirect holding even has to be 75% or more. Direct and indirect interest. Oh, sorry. For capital gains, it's going to be more than 50%. Only UK companies can get the benefit of group relief. So a company which may have been a non-UK one can establish the group, but a company who is a UK one gets the benefit of a relief, group relief. So if I give you one example, A Limited, B Limited, and C Limited, these are 3 of those companies. A holds the company, B by 90%, B holds the company, C by 80%. So at all the levels, we have to see the hold has to be 75% or more, which is good. Now, when I'll go to find an effective hold of A over to C, it's going to give me 72%, which is more than to 50%. Good. So this is going to be the group of A Limited, B Limited, and C Limited. Company can be a UK, non-UK company to establish the group. But the one who gets the benefit out of it is the one which is a UK one. This knowledge now we have to apply back to the question to conclude which of those companies will form the part of the group. This will not count because you also you can see that this balance is less than to that 75% mark. So this will break the whole connection of bar with vault also. So this is not on. This is definitely on. Bar owns the pommel by 90%. And on this side, this is totally on. So there are gonna be two groups, bar to pommel and hoop to ribbon. Well, they will not be able to interact in between. They are two different groups because what's connecting them both is an individual. So individual can have two groups, and these members of the groups, they can play with each other, but these groups cannot play with each other. Yeah, if Larisa was a company, then I would have called that the group of Pommel, Bar, Hoop, Ribbon, and Lisa Limited. But I cannot call this because the Lisa is a lady, is an individual. So she will act like a bridge in connecting the both. And after that, these two groups will independently, will separately going to. So applicable to the case, we will have to make the one group with the bar limited, constructing the group with Pommel limited. Holding it by 90%. And here we have hoop in the ribbon. Holding it by 100%. So this is the group number 1, and this is the group number 2. They will be able to get the benefit of tax relief in between, but these two, they have no connection to each. That's the first thing they wanted me to write. In relation to claiming the group, which of those companies in Bar Limited and Who Limited are and are not able to purchase the qualifying replacement asset, and state the period within which such assets must be purchased. I can write down the period. What is the date of the disposal of the building? This is the date the building was disposed. So this is the day the building was disposed, 31st of May 2025. So the building limited sold building 1 on 31st of May 2025 for 860,000, writing down the date of disposal, which is 31st of May 2025. We have to count down 3 years after the date of disposal and 1 year before. 1st of June 2024 to 31st of May 2678. So these are all those 4 years within this the investment must have to take place for the gain to be rolled over. Easily, we will end up getting 4 marks out of it because we've answered every bit of it, even 3 marks out of it. Explain with the aid of supporting calculations the additional amount that would need to be spent on qualifying asset in order for the maximum amount of the gain on the building one to be relieved by rollover relief. Okay, additional amount that they need to spend on the asset in order to get maximum rollover relief. Okay. So for this reason, the gain, we have it with us. The proceeds, we have it with us from the part A. So yeah, this asset has got a bit of a non-business use in it. And we need to quantify it in terms of months. So I can write down the proceeds, which is 860,000 on this page. And then I can just conclude the cost in one place. The total cost is going to be 315,000, 315,000, 9,000 and 38,000. 362,000. 362,000. And the gain that we have worked was a figure of what? 498,000. Now, this line, Bar Limited used the building one for the trading purposes apart from the period from 1st of Jan 2021 to 30th of June 2022. So how many months can we see in that this building has been used for the purpose of not they have used it, non-business use? Jan 21 to December 21, the whole 12 months and 6 months from 2020 to 18 months. And what has been the overall ownership? This building was purchased back in 2019 and disposed on 31st of May 2025. So how many number of years can we see in between? 20, 21, 22, 23, 24, 25. 6 years.